This episode is brought to you by Marqeta. When it comes to your payments provider, you can't afford to compromise. Marqeta's modern payment solutions flex with your business without the trade-offs. Stable and agile, secure and innovative, scalable and configurable. If they say you can't have it all, don't believe them. Your business demands more. Choose a payments provider that delivers more. Choose Marqeta. Visit marqeta.com/Spotify to learn more.
Reality radio for a really great future. We're talking real money.
Hello again, and welcome to the program that we call Talking Real Money, because we talk about money, really talk about it. We really talk about it. We talk about it all the time. We talk about it on Saturdays. We talk about it on Mondays. We talk about it on Tuesdays and Wednesdays and Thursdays and Fridays, and then back around to Saturdays. Oh, we don't talk about it on Sunday.
Yeah, I tried to take part of the day off, if you don't mind.
Yeah. There's football. You're right. Okay.
There's football.
Well,
for some of us, not for
yeah,
me,
there's no football for you. I'm sorry.
Couldn't call it that.
Well,
sorry.
we in the previous hour or podcast, we talked about my singing, and this one reminded me of a little ditty.
Oh.
Tough to be a flipper.
Wow.
Houses aren't selling.
The first, when I read this stuff, I thought that was like day trading. It kind of went away, and then it didn't go away.
It was a lot like day trading, and there were a lot of FOMO people. The fear of missing out, folks. It's like It's so easy to flip houses.
Yeah.
Well, guess what? I don't think it's so easy anymore.
No, in fact, the number it's astounding that it's down about a third from 2022. I think I read that right. Yeah, there's a third less homes are being flipped. And we're talking about, buying a home, fixer upper, I guess in the old days what they called it. I don't know what they call
that's
it
usually what they were. They were homes in some sort of state of disrepair.
Yeah.
We just had a situation here in our town where a woman was very sick, and her house was like in 15 years of disrepair, and there were several.
Well, that's a pretty good neighborhood.
Investors who wanted to get their hands on this thing and flip it. But I could tell you, just from what I know the houses sell for and the amount of work this thing needed, their profits are going to be particular. They're probably going to be a little skinny.
Well, they point out here a couple of things. Yes, the cost of materials, all the things, you got to come in, you got to fix it up. That has gone up a lot in the last 5 years. The cost of money, quite a bit more than it was 5 years ago, too, right? If you're going to borrow,
I mean, you could borrow at 3 or 4%. Now you're going to be up at 8, 9, 10.
Yeah. And then they also add a part that I had never considered, and that is competition. That there a lot of people from overseas have come. They saw this happening, like, I'll give that a try. Why not? By the way, if they want to try that, wouldn't they rather be in the food truck business? We could talk about that.
Anyway, do you know anybody selling a pizza food truck?
No idea. No idea.
Okay. I'm trying to help you out here.
This is always about the easy buck, right? That's what I mean. It's not easy either way, but it always is the quick dollar, not easy.
And it really comes back to there still is sort of a subculture in investing, the real estate subculture, where there was an obsession several years ago, and this happened again. This happened previously in the 2000s. This happened back in the 90s, where we had these periods where investors thought that real estate was the only way to go, and then flipping became sort of a subset of that.
Sure,
all of it in the quest for an easy dollar. They called it passive income. Real estate has never been passive income.
No. Well,
no.
Unless you get real lucky.
No. I mean, even then, if you're investing in real estate, there is always work to do, and passive implies no effort on your part.
Good point.
The only passive real estate investment is a real estate investment trust.
Which, again, even compared to just a globally diversified stock portfolio, it's made a little less. So even there hasn't been, and there's a whole bunch of other tax things you got to consider. But back to this article. This is a fascinating time for people that want to be in this business, because now, in addition to the factors I just mentioned, you alluded to it, the market is softer. So you're not only doing all these other things.
It's a lot softer.
Yeah, it's harder to sell. And that adds a whole new wrinkle to people. When things are turning quicker, you could almost make a case like, well, if I really work hard, blah, blah, blah. But now with fewer sales, et cetera, tougher.
Well, demographics are against you?
Sure.
Because old people are getting older. Not enough young
Fast.
people are getting born or growing up.
The average age to buy your first home keeps getting later, right? Isn't it close to 30 now or something?
And the cost to do so is higher than it was.
Exactly. Yeah, that's right.
So the magic, if there ever was any, and there was a perception that there was some magic in it. You know, if you turned on HGTV, every other show was, flipping homes.
Well, you remember the time we were in Arizona and it was at that financial fest and there was like 10 people there all pitching their super secret way to be a house flipper and get rich.
Yeah, I mean, I can't remember the guy's name because I forget all these con artists' name, but there was a guy in Orlando who used to do a national real estate investing house flipping course where, he showed images of him by his private jet with his wife. It was all an illusion. He got in trouble.
Of cash
he went to jail,
et cetera, et cetera.
There's always somebody.
System.
Yeah, everybody thinks they have a system. And the reality is, I think the underlying message that we're trying to impart is that this, like every other magic trick anyone has ever invented for making money, is flawed, and there's only really one way to do it.
Yeah, and that's to save and invest for the long haul. If you want to be in real estate and own homes and rent them out for a long time, that's a business.
That's a business. I am not opposed to you being in business.
Nope. Different thing than being a flipper.
But it's a different thing, yeah. 855-935-TALK is our number, 855-935-8255. Give us a call. We've got lines open for you. We'd love to talk with you.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
We love helping you, helping everybody who listens and people maybe who don't even listen get this financial stuff right. Do a better job with it.
If they don't listen, how do
because you can tell them
or something?
No,
or sending out a
because
ray
if they don't listen, maybe over the holidays you're having a meal with your family and somebody's
given up on that.
Somebody's saying, "Well, I can't. My broker's doing." You
tired of arguing with people.
You can say,
not
"Hey,
do it.
Call these guys on Saturdays, Tom and Don." You may not listen.
I thought you were talking about me and my family.
But you can call them at 855-935-TALK, 855-935-8255. Call us, like Lisa in Colorado did. Hi, Lisa. Welcome to the program.
Hi, Tom and Don. Nice to talk with you.
Glad you called. What's up?
So I have a really quick question. I'm on the board for a nonprofit, and I created and managed an organizational account for this nonprofit at Vanguard.
Yeah.
And right now, everything's in VMFXX. And at our next board meeting, I was going to suggest to dollar cost average. I have 3 funds in mind. I'm going to pick one of them. So dollar cost average. So we have 25% in stocks and 75% in the federal money market. So I was debating over 3 funds. And I spoke with my friend who's a retired financial planner, and she suggested a different one than I was going to choose. So I thought I'd call and give you the exchange-traded funds that I was thinking
before
about.
we do that, can I ask you a question? You said the symbol was VMSXX.
Yeah, that's the money market. Yeah,
no, but it's
federal money market.
Yeah,
it's municipal.
yeah, no, it's the federal money market.
Okay, because it says VM. Give me the symbol again.
V is
V
in
like
victory,
in Victor, M like
Yep.
M like a man,
Frank.
F X.
F. Oh, I heard S.
F is in Frank.
Oh,
S.
I was going to say because the VMSXX is municipal, and I'm going. Why are you in a?
Don't need munis.
Okay,
All right,
so what are
did
your
friend
ETFs?
recommend?
Yeah, what are the ETFs?
I want to hear this.
All right. Well, my three possibilities are VOO, VTI, or VT.
Okay.
I got my favorite. What's hers?
Hers was VTI and mine was VT.
Okay. There's a U.S. bias
a no-brainer.
there.
Yeah, total.
Yeah, that's the U.S. bias. A lot of advisors have a U.S. bias because their clients have a U.S. bias, so they tend to lean that way.
VT is the total globe.
VT is the winner from my perspective.
No question.
No question.
Unquestionably. It's more diversification.
Yep.
You own a lot of markets that the U.S. doesn't have access, or you own stocks that are overseas. You should always be globally diversified.
We're in total agreement.
She said the reason.
Oh yeah,
I think the reason she chose VTI was she said it'll have less volatility, and I didn't think so.
That's not true.
No,
she.
Yeah.
Okay. No. That in fact that makes no sense because volatility is reduced by diversification. Anybody who's studied markets knows that, and apparently she doesn't know that.
Maybe she meant the least amount of risk. Maybe
I think I disagree with that too. I think that having greater diversification.
What's the standard deviation of the two different funds, VT versus VTI?
That is a very good question, and I'm looking them up. Let's see.
But just think about it generally, Lisa. I mean, the idea here is you're just more broadly diversified in thousands of additional securities, other currencies. I mean, it just, to me, on just an intuitive level, it makes sense to be better diversified. We've always believed that. We've said that for 30 years.
Yeah.
So.
Yeah, and the standard deviation for VT is 14.2 over 5 years, 14.3, and the standard deviation for VTI is 15.5. So VTI has a substantially higher standard deviation. It's a better Sharpe ratio.
And wait, before you understand what standard deviation is?
It's volatility.
Oh, yeah, I do.
Yeah. Okay,
Yeah.
It has nothing to do with Don's dating record. So the thing is, yes, we would.
I can't even remember the last time
I
I dated, so it's not a good one.
Date yourself.
Yeah.
So I mean, it, in my mind, no brainer. VT is going to win.
Yep. We both agree. 100%.
Your selections were right on.
Okay, and if I could, I'd like to make a little plug for Vanguard. I've been with Vanguard for a long time. I like their online and iPhone capabilities, and I never had to wait very long on the phone. So
that's good.
Good for you. That's good. Yeah.
We like Vanguard. We think a lot of Vanguard.
Because we want them to be really good.
We want
They've
them
had
to
their
be the
issues
best.
over the last decade, and
not
frankly,
big ones, but yeah.
But now they're pandering a bit that makes me worried about the Bitcoin thing and private. It's stuff that I wish they wouldn't do.
But probably Fidelity and Charles Schwab does the same, I would imagine.
For sure.
Oh, yeah, they all do.
Okay.
They all do.
Yeah.
You're absolutely right.
I'm going to drive 80 miles an hour through my neighborhood because there's a guy that does that too. So.
She's absolutely right.
No, your thinking, Lisa, is spot on. Yeah.
And so I just wanted to make one more point about ETFs versus mutual funds. I mean, if your account is in a tax deferred or a never tax, like a Roth IRA, it doesn't matter if it's in an ETF or a mutual fund. And I compared when I was moving my accounts over when I retired, the fees between the ETFs and the mutual funds and Vanguard, and it was pretty much a wash. Their bonds were a little more expensive with the ETFs, and the mutual funds was like 1 basis point more expensive.
Yeah, I think you can make an argument that having mutual funds and as you said, either a pre-tax or no tax, as you called it, account versus having ETFs in a taxable account, you can make a pretty strong case for that.
Yeah, and the fact is they're both cheap. They're both cheap. Either way, with Vanguard, they're really cheap. Thanks so much for the call. We appreciate it. We'll be right back.
Tom and Don are talking real money.
Meet the computer you can talk to. With Copilot on Windows, working, creating, and collaborating is as easy as talking. Got writer's block? Share your screen with Copilot Vision to help spark inspiration, and use Copilot Voice to have a conversation and brainstorm ideas. Or maybe you need some tech help. With Copilot Vision, Copilot sees what you see. Let Copilot talk you through step-by-step guidance so you can master new apps, games, and skills faster. Try now at windows.com/Copilot.
For your real life and real future, Tom and Don are talking real money.
While we were talking to Lisa, I kind of got off on a different track, and I was going to go into real quickly why I think her advisor is suggesting VTI over VT, and it probably in large part relates to the Sharpe ratios I was starting to discuss. The Sharpe ratio on VT, if you look at VT, you'll see the Sharpe ratio is lower than the Sharpe ratio. And I'm going to explain what that is. I'm going to explain what that is on VT. Yeah. The Sharpe ratio shows you a risk-adjusted return number that you compare. You can compare to investments. However, this is a 5-year number, and it's risk-adjusted looking backward. And the U.S. market over the last 5 years has dramatically outperformed the international market, therefore pushing that Sharpe ratio for the U.S. fund much higher, leading you to believe that going forward you are going to get a higher risk-adjusted return, which it's certainly not a fact.
No, and setting even that aside, again, as I mentioned about intuitive aspects, I just want to be invested in other places. There have been times when individual countries, not saying this will happen to the U.S., have had horrible performance. We had a horrible performance in the aughts, right, from 2000, 2009. Japan, that was the leader of everything in 1990, had to wait 34 years to get the Nikkei back to where it was. Yeah. 34 years. Yeah, and
I love
a long time.
I love the chart that Dimensional does, and you can find it on their website, where they show you the best performing markets each year.
Oh, right, yeah.
And I think in the last...
The quilt.
And we've in the last 20 years we've been the top performing market like once or twice.
Yeah, it's not very often.
Really.
I think on this point you'll find us immovable, intractable, and adamantine. I believe would be the correct term.
You know, that was last episode, and therefore
pardon me.
It was sort of lost.
Getting edited again?
Yeah, it's lost. 855-935-TALK is our phone number, and we're heading to Seattle. Charles, you're on. Welcome to the show. Charles?
Charles.
Hey, what's up?
Tom and Don?
Yes, sir. Yes. You got us.
I'm good. I got a question about Boeing. Do you used to have on the Boeing? I mean, on your website, the Boeing suggestion for the Boeing portfolios.
The VIP. Yeah. No, I don't believe we do.
Yeah. The VIP.
I don't even know what the offerings are. Actually, I do know what the offerings are because we have a guy that's still a client who does some of his money at Boeing. So
we stopped doing that a few years ago, and.
The lawyers always get in the way of the fund.
People get nervous about that.
But you can ask us about the funds.
Well, what would you like to know?
Sure.
Okay. That's all right. I'll pull up some funds later and call you another time. One other quick question. What do you think of what do you think of the VOO?
The S&P 500?
Standard Poor's, I think part of your portfolio should be in the VOO.
Yeah,
but we
10%.
just talked about this. Yeah, not all of it. You should have U.S. smaller companies, U.S. small value companies, international large, all those other asset classes. The S&P 500 is 500 stocks. We want you to own 10 to 12,000. Yeah, something like that. So a lot. So it wouldn't be the entire portfolio, yet people make it. And by the way, again, as a reminder, it's about 35% of that is in 7 stocks. You want to have your portfolio, a third of your portfolio in 7 stocks? I don't care how good they are, how much AI they're going to generate, how much of AI they're going to be more efficient with. Wouldn't be my portfolio.
Okay.
All
right. One other thing about, through Les Schwab, can you get AVGE?
Yes, sir. You sure can.
That would be Charles Schwab. Schwab will rotate your tires for you if you like, but they won't. Sorry.
and they won't. They'll rebalance your tires, but not rebalance your investment.
That's good. Just teasing you there. Yeah, Charles. But yes, Charles Schwab.
Yeah.
And yes, the answer is yes to that.
Yeah,
So
absolutely.
So it sounds like you can buy a lot of stocks from Schwab that are Vanguard stocks and so on.
You can pretty much get anything you want through
Yeah.
Schwab. Yes.
And
a few
it's not
things
an
that they don't
extra fee
trade,
on
but
that,
not much.
Okay. And there's no extra fee on that?
There
Schwab,
is
or
on mutual funds. On some,
Yeah, but
for
the
example,
ETF
if you buy a Vanguard ETF, there's no fee.
No.
If you were to buy a Vanguard mutual fund, I think the fee is $79.
It's something. It's spendy.
Yeah, I think it's pretty high.
Oh,
If I was going to use Vanguard funds, I'd go to Vanguard.
Yep, I would too.
You
But
avoid
if you're
any
going to get
possible-
if you're going to get ETFs, get them through
Doesn't
Schwab.
matter.
Les
get 'em
or
anywhere,
Charles.
but-
okay.
Yeah. Well,
Okay.
put your,
All right.
put your chains on for some rough roads ahead there. So how about that? Thanks, Charles.
Yeah, they're needed. Yeah. Okay, thank you,
You
guys.
take care, sir.
By the way, I got one other note. I forgot to mention this. I meant to mention it earlier. You can be on the wait list for Retire Meet 2026 by going to retiremeet.com.
What? I thought
It's up
tickets
there
were
now.
not even on sale yet.
But you can get on the wait list right
to
now.
buy
and I'm
tickets.
going to lose weight, so you get on that wait list immediately. So,
Okay, we'll be back, I think. Maybe.
Tito's Handmade Vodka is America's favorite vodka for a reason. From the first legal distillery in Texas, Tito's is 6 times distilled till it's just right. And naturally gluten-free, making it a high-quality spirit that mixes with just about anything. From the smoothest martinis to the best Bloody Marys. Tito's is known for giving back, teaming up with nonprofits to serve its communities and do good for dogs. Make your next cocktail with Tito's. Distilled and bottled by 5th Generation Inc., Austin, Texas. 40% alcohol by volume. Savor responsibly.
Reality radio for a really great future. We're talking real money.
I just crunched the latest numbers on the S&P 500, and if you toss Tesla in, which you probably should, because the 7 includes both of the alphabets, A and C,
Yep.
and so you throw Tesla in, the biggest tech companies in the country make up 39% now of the S&P 500.
again, it's just that it's concentration risk that you should not and don't need to take. Again, that's why, especially, you don't own just the S&P 500 because so much of your portfolio is in a very small thing. And by the way, that small thing, I was talking to a client about this recently, is priced to perfection.
Yeah.
This is the part that worries me. All that AI and everything that everybody's going to get rich on, the minute it doesn't happen,
Well, we don't
look out below.
I hate predicting.
we don't know,
I
but I'm
don't
just
know.
saying that's why you diversify. That's why you diversify.
855-935-TALK is our phone number, and I tossed Tesla in because I'm pandering to Jason in Sammamish. Jason, welcome to Talking Real Money.
Jason, we're going to short Tesla, but you can visit me at my funeral, I guess. So
I always appreciate a little pandering. Thank you, guys. I appreciate that. All right, so I've got to weigh in on the whole VTI VT conversation.
Okay,
So,
you as the poster child for recency bias. Yes, okay.
and the concentration risk guy, you go right ahead, please.
This has nothing to do with recency. Listen, okay. So VTI, 24 years old. Okay, VT, 17 years old. Over the last decade, we have 12.5% for VTI, 8.5% for VT. Okay, got a lower cost. VTI has a lower cost basis, better dividend yield. Also, when you look at the entirety of the funds, both funds, we're talking about over the 24-year period for VTI, about 490% almost up versus the shorter 17-year period for VT, about 134% up. So,
I thought you just said this wasn't about recency bias or
That's
something.
totally about recency bias.
24
That's
years?
exactly
No,
what
no, no,
that
but
is.
see,
24 years?
No, 17 years.
17
for
for
one thing.
VT.
And most of that has come in the last decade.
VTI is 24 years. It's the older fund.
Right, but
But VT
you
didn't
can't. You
exist.
can only do a comparison over 17 to 17, and you're going to find that VTI beats the tar out of VT over 17 years because for almost all of those 17 years, for 15 of those 17 years, the U.S. market dramatically outperformed the foreign markets.
But you have to okay. But to support VT over VTI, you basically have to be making a bet that you think the United States is not going to continue to be the global leader in basically all areas.
That's not what
I have no idea.
No. You're putting words in our mouth. No, we are not saying that. What we're saying is that it is much more likely that we will see the international markets do a little bit better because the U.S. market has been the focus of all this money for a long time, just as they did in 2000 to 2010. If VT and VTI existed between 2000 and 2010, VTI would have returned almost nothing, and VT would have returned probably about 6 or 7% a year.
Yeah. And by the way, because this is the number I think that really matters. If you go back to 1970, which is about as far back as you can go really with international stocks, having a globally diversified portfolio has done far better. Well, I think it's 1.5 or 2% a year.
Yeah,
than just being in the S&P 500.
Right,
Again, longer periods of time. That's what I trust.
And the funds don't matter. The funds don't matter, Jason. They do not matter. The funds don't matter because we're talking about the markets. Now we're just talking about the markets. The funds are they're just vessels.
I understand that, but I'm just saying that I still feel that you guys are basically making a bet that Europe or Asia are going to outperform the United States in the long term. And
Nope.
We're
predicting they're going to perform similarly over 50 years. And that's really the only number, 30 or 40 years maybe. But Tom's absolutely right. If we go back as far back as we can go, because the more data is better, right?
Would you agree with us there?
It is better, but also the world has changed a lot since 1970.
It's different this time.
Whoa.
Okay,
so you're saying the United States
before.
is so much better than it was in 1970? In 1970, we were declining.
Of course,
the Japanese were killing us. So we've bounced back, aren't they?
But look at the...
Okay. Yes.
Yeah.
It sounds like you're making a bet. You're betting the U.S. is...
I'm looking, by the way, I'm looking at 97 years of data, no, 55 years of data on Mark Webner's Mark side IFA, and if you're in 100% global portfolio, 12.1% return versus the S&P 500, 10.9. That's what I'm talking about. I don't know anything about the future. And by the way, the U.S. could still be the most dominant economy, but those prices of those shares are already built into that being the future. They've already passed that on. That the people that trade stocks, they've already incorporated that. So that's just realizing what they've already bet on. That's my take.
Right. I understand there might be a correction in the U.S. Some of these AI stocks. I agree with you that they are priced to perfection right now in many cases. But even with a modest, even a fairly significant downturn in those, I still see the long-term trajectory of, U.S. entrepreneurship compared to what's going on in Europe, just the business environment.
Okay, but again, we're coming back to your feelings and your beliefs and your predictions. We're not trying to predict. Our belief, there is no prediction in what we're suggesting. Our belief is that owning more is better, owning less is worse. That's it. That's all there is to it.
And by the way, back to just to take on that argument even, that is somehow suggesting that the U.S. economy would grow faster than places that are emerging. If you're making a bet on that, you'd have to say those places that are still up and comers. You've read Bill Gates writing about this, a growing middle class there, growing companies, all those. Look at what South Korea's done the last 50 years. That's what we just want to own those things as well.
South Korea went from a third world economy to first world in no time at all. It was a record. 855-935-TALK is the number. Jason, thanks so much for calling. 855-935-8255. Give us a call. We have a lot of time left.
Tom and Don are talking real money.
So you want to start a business. You might think you need a team of people and fancy tech skills, but you don't. You just need GoDaddy Aero. I'm Walton Goggins, and as an actor, I'm an expert in looking like I know what I'm doing. GoDaddy Aero uses AI to create everything you need to grow a business. It'll make you a unique logo. It'll create a custom website. It'll write social posts for you and even set you up with a social media calendar. Get started at GoDaddy.com/Aero. That's GoDaddy.com/AIRO.
Your guides to a really great financial future. Tom and Don are talking real money.
I want to thank Charles for getting the text line going over the Les versus Charles Schwab. And by the way, not to picking on you, Charles, because that happens a lot. People say that.
Well,
you mean go down to Les Schwab?
Les Schwab is all over the television.
And they're big branders here in the Northwest, but so that's gotten the wheels turning. So I want to thank Paul for having the best one. He said you should get Les Schwab to be the sponsor, but you have to change the name of the show to Talking Wheel Money. That's pretty good. I thought that's funny. Thanks, Paul. Wheel,
do you have a
wheels
club
go round and round.
Of bad dads?
Does that surprise you in some way?
Is there an organization I'm not aware of?
You're not going to be let in either.
I guess not. All righty.
Thanks, Paul.
I want to take us off in a totally different direction and maybe back to talking real money at 85.
Wheels go round and round.
Real. 855-935-TALK. That's the number, 855-935-8255. And Debbie in Camano Island, welcome to the program.
Hi there.
Hi, Debbie.
I have a basic question. Unfortunately, I don't have the money that a lot of your callers do, and so I'm
me either. By the way,
as much
so
as I
don't feel bad.
so anyway, it's pretty basic. I'm 73 years old. I've been with Vanguard for probably 10 years, and had two funds that have done well through bad times. I just sit back and hold my breath and wait. I haven't changed anything, and so far they've got me through some bad economies. And now it's getting to the point where I'm 73 years old, and I don't have the time to lose some money and get it back. I don't know if I should be staying with those funds or going with something else.
Well, what are the funds? Or give us one of them. Give us one of the tickers.
Okay. 500 Index Admiral, large cap.
Okay. And what's the other one?
Wellington Balanced.
Okay. So there's a big difference between those two funds. One is all in stocks. Those are the riskier things that have made more over time, but they'll provide great volatility. As you said, you have to hold your breath, which is a long time in 2008, 2009. When they go way down, as that fund did in that period of time in the big bad bear market. Wellington, on the other hand, is a balanced fund between stocks and bonds. But the problem is both of them basically hold the same type of stocks. That's the issue I have. Part two, you need to have somebody help you understand how much you're trying to make with that account and how much volatility you're willing to accept.
Yeah, Wellington is also an actively managed account where they're trying to pick the right places to put the money, whereas the other is an index. But you, as we were saying to others before you, we believe in much broader diversification, and we also believe that the portfolio has to be created not based on what we think the future is going to bring or what's been good in the past, but based on what you need to own for your goals and your psyche.
And let me ask you a question. Is this in an IRA, like an individual retirement account, or is it just in a regular, what we'd call brokerage account, or do you know the difference?
It's in an IRA.
This is going to be easy. Yeah. Here's my suggestion. At 73, two things. I think you could go to Talking Real Money and take the risk quiz, because that would give you, it's simple, very easy to understand. Then the likelihood is you could use a thing called a target date fund, because it takes all the guesswork out of
and you
all
could do
this.
that at Vanguard. It'd be so easy.
And you could do it at Vanguard, and it'd be very cheap, and they'll manage that risk for you. So let's say you're 73. You could own the, for example, 2025 target date fund. It'd be easy to find. I think Don's even going to look up the ticker for you. Just put all the money in there, because then it balances between stocks and bonds. It's going to temper the losses when markets get horrible. It's going to give you some growth over time, and it's going to be more diversified than just being in the Standard & Poor's 500, which we've spent quite a bit of time on this episode talking about the risk of just being in that one particular asset class. So I think it'd be a great way to do it, and there's no tax ramification to selling those two funds, putting it all in one target date fund.
VTTVX is the symbol for the 2025 fund. It is 35%, 32% stocks and 75% fixed income. No, I'm sorry. It's about 50-50. It's about 50 stock,
50% in stocks,
50 fixed.
and so you could expect hopefully 6 or 7% growth over time, something like that.
It's
just be fine.
It has returned on average over the past 15 years about 7.5%, 7.75%.
Okay, don't count on that. But I think that'd be reasonable. And then the reality is, you don't have to do anything. It's all done for you. You don't have to worry about it. Think about it.
Yeah, we agree. Again.
Okay. Can you give me the initials again? It was
VTT.
What was it?
VX.
It's 2 T's. Okay.
VTT.
Victor Thomas
VX.
Thomas.
Victory X-ray.
VX.
Victory S.
Okay, good.
X-ray. Yeah, got it. That would be my way of doing it. Then the
sheer simplicity.
It reduces the concentration.
Massive diversification.
Exactly.
And
Low cost.
It's so cheap.
Yeah.
It's what is the cost on that fund? It's
really hard to
0.8
argue
of
with that.
1%. It is a portfolio of
0.8 of 1%.
Yeah, it's a portfolio
so
of the Vanguard Total Stock Index, the total
You
bond.
mean 8 basis points or 80 basis points?
0.08.
0.08. Yeah. It's just
8
cheap,
basis
cheap.
points.
So, yeah.
So, plus
really
it even has a
great
tips
way to
fund
do
in it.
Might give you a little protection from unexpected inflation, were that to come along.
A little bit of
again,
everything all rolled into one, and then they make it more conservative as you get older.
Yeah.
Okay. Okay, great. Thank you.
You're very welcome.
You're
Debbie,
welcome.
thanks for being with us. And thank you all for being with us. We really appreciate you being there. Remember, you can listen to our podcast on your favorite podcast service, and there's more than just the weekend show. We do other shows that you don't hear on Saturdays, so you got to learn how to listen to podcasts. Do that soon.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan, one that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
For your real life and real future, Tom and Don are talking real money.
And we don't just talk about investing and saving and spending. We also talk about how, communities can help themselves become more financially stable. It's tough being
That's a bit of a reach, but okay,
it's
sure.
tough. Well,
All right.
I know. I'm the president of an HOA, and we've had
That's true.
back in
you are.
2008. We had some financial struggles with people not paying their dues, and this idea never occurred to us, and thank God it didn't.
So in Lakeview, Oregon, where they're having trouble paying the bills for a variety of reasons, has financial mismanagement, bankruptcy of large employers, etc. This is in Oregon.
Well, you said Oregon.
They decided
Lakeview, Oregon. In Oregon. I'm hoping Lakeview,
I just
Oregon,
like picking on
isn't
Oregon.
in Ohio.
That's all. Exactly. So what did they do? They needed money because they didn't have enough money to plow the roads from snow, keep things moving in the winter. So they decided on a calendar, which, calendar, local citizens in the calendar.
Yeah,
sell
like
to your
a
friends
dog
and neighbors.
calendar, or maybe naming the snowplow calendar, that kind of thing. Maybe
this is the Outback Naked calendar. These are actual citizens of the town, and now they put things kind of in the the way they do in a picture, so you can't quite see the private parts, but you can see basically the people are naked. And so they went out and did this, like one's kind of behind a block of wood. And they've raised $13,000 so far. So now I was thinking, if I was asked to be in this, which of course I wouldn't be asked. But,
well, I'm telling you, looking at the picture in the Wall Street Journal, the woman who did the naked thing probably shouldn't have been asked. I'm sorry, no offense,
for me,
but
I'd be trying to hide behind Climate Pledge Arena, something like that, so that very little bit would be seen But this is very creative. $13,000 is great. The calendar is $32, so this is not cheap. And think of how much it would have been had they decided to employ models instead of doing this themselves.
Okay,
so,
yeah,
way to go,
I'm
creative
looking at the
thinkers in
pictures
Lakeview.
now, and
I didn't go to that.
they're
length.
not
Thank you
very
much.
naked, and that's really good.
Okay.
Actually, we've got.
Yeah, because one of them was 77, I think.
Well,
it said, or
we got
something,
the
so.
bike shop owner. He's wearing an apron, thank God, because he's a big old bearded guy. We got a woman who's got her cowboy boots on, hiding behind a vintage radio, which is for the best. And then we've got a dude who's picking.
No body shaming on this show.
Well, no, I mean, I'm sure his body's fine, but they're all just old as us.
Yeah,
they're old as us,
well,
and I would not pose naked.
Ouch.
No.
I would behind Climate Pledge Arena, but other than that, no way. So there you go.
Yeah.
Merry Christmas.
No, I wouldn't even hide.
On the
No,
list.
because that would mean I'd be naked outside Climate Pledge Arena. So there's no
You'd be
chance.
arrested shortly thereafter.
Arrested? I'd be committed.
You'd be cold.
I'd be cold. All right, we're out of time. Thanks so much for being a part of the little get-together we call a program. Remember, you can listen to these shows as a podcast on your favorite podcast service. Just look at talkingrealmoney.com. If you want to get some nice Christmas stories, seasoned readings on your favorite podcast service.
Absolutely. Give it 5 stars.
Give it 5 stars
Deserves
if you listen. And if you want a little bit of help with your money, our advisors at Appella, they help do that. It's a little busy this time of year, but we'll try and sneak you in, and it's free, and there's no obligation, and there's no high-pressure sales pitch. All you have to do is go to talkingrealmoney.com. That is our lovely website. And that's where the risk quiz resides, lots of other good stuff. You can even listen to the podcast there. And then when you get there, go to the form that says Meet an Advisor and just set up an appointment with one of our advisors, even Tom.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.